The S&Ps are likely to have one more week of congestion. This is April 22nd. It's after the market closed. We enjoyed the chaos of today and the ongoing directionlessness of the market, where it looks like it's going to go down and it goes up. It looks like it's going to go up and it goes down. This probably will continue until the 28th or 29th of April, where the final high point of what we expect to be the fourth wave of this sideways phase should turn down hard into the final low. And we're looking at a low somewhere between the 6th and the 15th of May, with the highest probability is around the 13th of May as a bottom. We're looking for 47.50 as a price. And right now the market is up in the 5,400 area after being at 5,500 and at 5,100 and now 5,400 in the last week. So the reality is that the market is in a consolidation phase, trying to figure out what it wants to do. And what we think is it's going to wind up going lower. And then after the low in May, the market should go up and could continue to go up for a number of months into the future. Okay. Now what we've seen is the cycles that we're looking at are remarkably accurate. The 1998 market looks almost identical to this one. And what we found out recently is there's a thing called the basis trade, which many of the large hedge funds do. And it's an arbitrage trade where they basically try to catch the distinction. They try to short the futures and buy the cash on the bonds, on the treasury bonds. And in doing so, they capture a small profit, but they can do it over and over and over again because the spread will always go to zero when the futures expire. Okay, and so they do this every day, every month, and it almost always make money on it. And they take the money that they've gotten, they borrow money from the bank and leverage it up sometimes 100 times. So they could take $1 million and leverage it up to 100 million or even larger amounts. And so the reality is there was a tremendous deleveraging that happened when the tariff situation came around on a sharp, unexpected note, and it forced a lot of hedge funds to liquidate positions they would never do. The banks forced them to do it. That's called a margin call. There's a great movie called Margin Call. You can see that movie and get an idea what this is about. And what's happening now is that this is all coming into play. The same thing happened in 1998 with long-term capital when they were put out of business based upon one of their basis trades exploding in their face. And ultimately, the Fed had to come in and save the day. The Fed's going to have to do something similar now. And one of the things the Fed can do is take the responsibility for the trade directly onto its own books. And therefore, the hedge funds won't have that risk. They won't be in a situation where the whole thing could collapse. Same thing happened in 2008, which ultimately led to the collapse of Lehman. And the Fed probably made a mistake back then in letting that happen, because it caused a huge avalanche of fear, excited further in the public, and everybody wanted to sell. Same thing happened around 2019 and 20. You had the same type of event, the basis thing blew up. So in this situation, because 1998 seems to be the number one best match, it also indicates that the probabilities are the Fed or some government agency is going to come in there and save the day again over the next month or two. And the game will, again, the normalcy will return, and the market will continue to rally, probably, in my opinion, making new highs before too long. Now, it may not do it this year. It's possible it will go up again into the August high, which we expect, go down again into October, and then it would take until next February or March before we see new highs. So we also note that the 147-week cycle has been repeating continually correctly. The 162-week cycle continually correctly. The 1990 market 34 and a half years ago continually correctly. And the 2005 market 19.86-year cycle is also what we've been mentioning over and over again. It's doing the same thing that market has done. And basically, it goes down for a final low in early May. They all do it. They all go sideways another week or less, and then they go down hard into the final low in early to mid-May, and then the market rallies. Okay. Now, what's interesting is the 1926 market is also one of the patterns that we came up with. It came out as a very, very good fit, not only recently, but for the last 2.5 years. It's been repeating the number one. It was the number one on the hit parade on the weekly bar chart. And the 1926 market is doing it exactly the same way as the 1998 market. And one of my students came up with that. He saw the two of them. He overlaid one chart on top of the other, and it was a remarkably good fit, not only recently, but way back in the past and way going forward in the future. They basically agree the market's going to explode upward in June, July, and further. Okay. Also, the short-term cycles are often related to the 1 month, 2 month, the moon cycle, basically. In many cases, you can predict 2 or 3 days in a row, or even intraday, what's going to happen, because there are short-term patterns that are also there. It's a little harder to find them because there are more cycles on the short term than there are on the long term. But nevertheless, none of this is really surprising. The volatility, the extremeness of it, that's uncertain. You really don't know if it's going to be a 5% or a 10% move, but the timing has been very clear and continues to be clear. Knowing whether to be short or long has been clear and continues to be clear. And basically, we're looking to stay short until the middle of May and then begin to get out of shorts, begin to lighten up on the negative side of it and start thinking positive. We talked about the astrology and that the volatility would decrease, and it has. The VIX made its high price around the time of the April 7th low in the S&P. The volatility reached a peak. It went down, up, and now after today's action, where terrible news for Tesla caused a huge rally in Tesla. At the same time, Trump lightens up on the projection for the Chinese tariffs. At the same time, some positive news from apparently for the market about the Ukraine, all within an hour of each other. It's almost like it was set up that way. But it doesn't matter. The bottom line is this is part of that congestion period. It was meant to rally. We expected a high on the 23rd of April, a short-term high. Looks like it will happen. It looks like after that it'll probably go down again a couple of days and then up again into the end of the month. And then, down hard to final bottom, expecting around 47.50. So I've said a lot here, but what's important to recognize is that we are interested in the knowledge. We're interested in not only knowing what the market's going to do and not only making these videos for the public every week, but we want to share the knowledge of how to figure it out. Okay? We want to give signals. People want me to make more videos and they want me to do more and give out signals. 25 years ago I did that. Right now I'm interested in educating the public so that they can be self-sufficient, so that they can stand on their own feet, so that they don't have to listen to the experts. They can become the experts. Okay? It's not that hard. All right. That's the story for this week.